I recently interviewed Tom Gober, a certified fraud examiner who's been working for over 40 years investigating life insurance fraud. In this episode, we're breaking down some of the key points from this almost 2 hour interview, including the rise of private equity, private credit, the reinsurance, which, shocker, was like a big thing takeaway for me and just learning all this that are inside the life insurance industry. And we also covered how some companies may be taking more risk, blurring transparency, and ultimately incentivizing reward over stability. So Dom, you better buckle up, man. This one's going to be a heavy episode, but I think if people have not watched my interview with Tom Gober, it would be worth pausing this, checking out that video down below, and then coming back to hear kind of my take, Dom's take on this really powerful, brain-heavy conversation.
Yeah, Caleb. And to be transparent, after watching the video, I was truly humbled. Like genuinely, the reason why I was so humbled is just because I realized that there's so much out there that even with me being like full time in the insurance industry and space, that I just don't know. And you can imagine if we don't know, how is the consumer supposed to know? And I think that's the problem that becomes scary at the end of the day, is that we need people like Tom, and then for us to be advocates and to have a platform to share information like this. And I don't always, to be quite frank, we produce so much content, I don't even watch all of our content. And so when Caleb's like, hey, you need to watch this, and then I watched it, I was just like, wow, watched the whole 2 hours and was just flabbergasted at just what is going on, a couple of aha moments. And I think that today would be a good point, a good thing for us to talk about some of those key points that came from that interview. And there's lots, and I kind of started going down a rabbit hole afterwards. But some of the key things that I think that we can talk about today is just the natural reasons for insurance and annuities. Like these companies are supposed to like offer like massive stability, but with private equity coming into the play and reinsurance being what it is, that it shouldn't be the way that it is, unfortunately. Like, what is the massive impacts that it has, some of the lack of transparency that is in the space, and should there be more, and what that looks like. I think just dialing in just reinsurance, the way that it should work and how it has in the past, and versus like what it is and how it's actually operating right now, and some of the risks that it's intended to do, but the actual risk that it's causing. Some of the things that I thought was super fascinating that you guys touched upon is like Ohio National and like the demutualization of these companies, and some of the really strong benefits of actually having a mutual company and your policy with these mutual companies, versus you see these companies demutualized, whether it is Ohio National, Prudential, like et cetera, and the benefits that it's obviously offering these executives, but the harmful nature of not just to the policyholders, but the entire industry and what that's doing. And then something that I thought was super, super fascinating that wasn't necessarily touched on because it was like just an insurance focus, like what's going on, but the acceleration of the risk taking that's coming from private equity and the private credit. I actually do believe like this could really be the catalyst for some of the next big 2008 financial crisis. And it's funny just because people always say like, oh, like the whistleblower, like you've been saying that for years, right? Years and years and years, but like nothing's happened. And that's usually what happens, is like, as long as things are always good on the surface and things don't essentially implode, like quote unquote, the whistleblower always is wrong until they're not. And I do believe that something like this has the potential to be a massive catalyst for the future to come of a big implode across the entire economy, not just in the insurance space, which is kind of crazy to think about, of like our industry, what's going on can be a cause of massive end of a business cycle and recession for years to come. So it's just super, super crazy when you start to break it down and reveal the layers underneath it.
Yeah, I think that was well said, Dom. And probably as I reflect just after our conversation, because I did 2 other episodes with him that we'll be releasing on the Better Wealth Show sometime in the near future. So make sure to go subscribe and hit the notification bell if you want to be notified that when they drop. And one of the things that really just took me back is the concept of private equity, I actually don't have a problem with private equity, just the concept of it. But if you take them out of the insurance space, like private equity are a pool of money that's going to take on risk. Most things aren't going to work out, but you almost like know that that's what you're taking on because you're the investor. You know that you're going to lose a lot, but the ones that are winners are going to be huge winners, and you take on that risk. And at the end of the day, if private equity takes over businesses and the businesses fail, yeah, people can lose their jobs. Maybe someone's benefiting from that company, and private equity buys a food company and it buries it into the ground, and now you don't get your favorite Cheetos or whatever. So it's like I get like there's some consequences there, but it's all like the consequences are capped, I will say, and obviously losing your job, terrible, but there's also capped as well. When you're talking about this type of behavior into a business that has literally, like, insurance is all about, it's a piece of paper that's built around the credibility of a promise and long-term thinking, and not just long-term thinking, long-term commitments. And one of the issues is some of these companies don't have a face tied to it. So no one feels actual like pride and responsibility for the promises that they made. And think about this. And Naval even talks about this. There's something very powerful from someone whose name is on the line, because you will go the extra mile if your name's on the line. And yet, even what you looked at with, Ohio National and some of these other companies, most people can't name who's behind them. You can't name them. And so there's that aspect of like these institutions are making these long-term promises, and then there's an incentive to, not go back on your word, but make an offer to a group that isn't always incentivized to do the right thing. And I just think that's a huge problem. I'm not a big regulation kind of guy at all, but I do think there's a difference between buying a tech company or a food company or even a manufacturing company versus taking over a company that has lifetime promises and running it potentially in the ground. And then, oops, that it's now this private equity's person's fault. But let's be honest, it's not just private equity. I mean, private equity should be better, but it's also like there's someone that had to turn the keys over. So that's just an observation that I think there's got to be some type of regulatory step in some capacity, but then there's also, like, I'm telling you, Dom, if the producer and the advisor stood up and said, we're not going to tolerate this, I'm not going to write for companies that do these shenanigans, this would not be an issue. Because guess what? These companies are supply and demand based companies based on the people that are willing to represent and sell their products. So if everybody who's a financial professional said, we're not going to tolerate this, the company would be forced to figure it out, or they would be worth nothing. So for example, if a company knew, hey, if we go this direction, no one's going to sell our product. By the way, guess who's not interested in buying your company? Private equity. Now, even in saying that, there could be a world where private equity doesn't care because they're just going to utilize the balance sheet and just suck out the money for their own good. But that's just pure evil. And, that if the intention to take over insurance companies is literally not even to try to help the consumer, I think that needs to be sniffed out, and people need to go to jail for that. Before I mention the reinsurance stuff, any thoughts on my mini monologue rant?
No, I think your mini monologue rant was spot on. And if you start to actually like peel back the onion and ask like, well, how did this start? When did this start? And it really started like around the tech bubble phase, where a lot of these companies really did start to demutualize, like some of like the big name ones. And the private equity, that's when their opportunity can come in, is when a company actually demutualizes, right? And so if you look at like Prudential, MetLife, John Hancock, like those are some massive carriers that we like know, that we hear the names from, et cetera, that's when private equity has the opportunity to come in and create what they do best, which is people don't realize like private equity is some of the most skillful humans on the entire planet at making money. They are better at accounting and they know accounting better than most people in the insurance space alone. These guys have so much ability to make so much money at whatever cost that they now are quote unquote obligated to do to the stockholders, right? So they're actually in ethical alignment with what they're supposed to do, which then creates obviously this disalignment with what the insurance industry is supposed to be stood for. Is you need the insurance companies to be around for a long period of time. You need these annuity companies to be around for a long period of time. I think you said it best in the, or he said it, Tom said it best in the episode. It's like, what good is this long-term product, sophisticated product, if the insurance company is no longer around, right? It actually does it no good at the end of the day. And that's what we're creating, is we're creating a playground for these, private equity to come in, create as much money as humanly possible, create all these long-term, short-term, long-term risks for the insurance company to not be around, and life insurance and annuities to no longer have a good name. And it ruins it for all the other mutual companies or other companies that are playing by the rules or doing it the right way.
Agreed. And I have never been more convicted that the mutual insurance conversation is never been more important. Never been more important, because it is, if someone stays mutual, you don't have to worry about private equity. Now we'll talk next about, it doesn't make them immune from some of the other shenanigans, but it creates a lot less incentive. It's like a limit the temptation, a limit the, like, create a bumper so it's impossible to go in the gutter kind of deal. And like mutual is that on steroids. And so it makes me very thankful, because pretty much across the board we've been doing this, and not because I knew Tom 10 years ago, but just some of the people that I've learned. It's like, it doesn't matter if there's a company that pops up over there that's saying, hey, we can make it that much better, more attractive, blah, blah, blah. It's like, okay, what is the credibility of your promise? And Mutual has always had a good story, because it's about, like, you are an owner of the company. If you're a policy holder, the profits go back to our people. And even I will take private equity out of it. Even a stock company is hard to get your mind around, because they're supposed to have competitive products, but the profit doesn't go to the policy holders. The profit goes to the shareholders. And so now it creates an interesting dilemma, right? It's like, okay, how in a world over the next 30, 40 years does a stock company compete with a mutual company if all the economics are the same? And so it's just like, there's, money's got to go from somewhere. So just like if you just like think through it, you'll say, well, I'm not saying that all mutual is going to outperform stock, but if I had to bet, I would probably bet on incentives. And so that's just like, we always knew that. And you just realize that the gateway is private equity is just an accelerator, and maybe coming in not really caring about 100 years, maybe caring about year 3. And so, but the other thing that I was like woefully uneducated on is reinsurance and how that works. And I knew that insurance companies use reinsurance, and it's a way to make sure that, and a lot of companies do this. It's like, if you come in and it's like, Dom, if I have $20 million of life insurance on your life and you die, it could like wipe me out, or it could lower our reserves more than I'm comfortable. So what I'm going to do is I'm going to have other people actually buy that risk and diversify it. That's the whole idea of insurance, is reducing risk. That's why someone has insurance, is to reduce risk. And so it's obvious that and a company that you're going to sell that risk to is not going to just take a loss. That's not good for anyone, because that company, if they go under, guess who? They're no longer able to keep their promises. And so you want, in a free market, for there to not be any free lunches, because you want to make sure that if you're working with a reinsurance company, that they're stable enough to make good on their promise. And so when I heard that these companies, it's legal in some of these states to have sham reinsurance, essentially companies and contracts that you don't have to disclose how much you're funding, what they're investing in, how many it blew my mind. I'm like, that's insane. And and it's one of those things where it's like, when has being in the dark ever made things better? Like transparency, transparency, transparency. Even if you're going to do something like that, which you're not even transferring that risk first and foremost. If it's the equivalent, I think we said this in the podcast, where it's like you took a risk on the first floor and transferred it to the basement, but it's still in the same company. So the idea, it's like redundant to say your reinsurance is a sub of yourself. So the only reason why you would do that is to do something. And why would you do it overseas? To do something that maybe wasn't going to look great in the United States. So it's just, you're not setting yourself up for success in something like that, number one. And then number two, it just, I think it's a gateway to so many bad things that could happen. So yeah, I mean, that was like very eye-opening and very alarming. And to see some of the companies that are doing a lot of this and increasing that. And one of the videos that has not dropped yet, we go through a bunch of companies, and I saw firsthand in his crazy spreadsheet all the companies out there, and I was amazed by that there are many companies that are doing things that you can, again, we can't say are sketchy. We can't say that they're absolutely doing the wrong thing, but then it's asking the question, why are you doing it to begin with? And why aren't the insurance regulators actually demanding that they see disclose? I mean, this affects the insurance company, so this is just some loophole, but like it should be their business. So that was probably my biggest takeaway in just is the reinsurance, let alone, like he mentioned in the podcast, he's like, yeah, some of these investments are way too risky. And I said, hey, I took an insurance class in college. Isn't that against the rules? And he's like, yeah, but if you don't enforce it, what are you going to do? And I think we looked at one company and they were like, they was so out of whack their investment. And I'm like, why isn't anything doing it? It's like, well, there is this tendency of like, you're being too big to fail. And you don't want to necessarily, if you're regulated by the state level, you don't necessarily want to be the state that's unfavorable because people will just get up and move. So there's a lot of potential issues here. But a lot of this stuff is technically legal, which is wild to me.
We've helped people unlock millions of dollars in hidden value just by reviewing their old life insurance policies. Unfortunately, thousands of people do not have life insurance policies set up properly, which could be costing them a lot of money. If you have a policy, the few minutes it takes to fill out our form could be the difference between continuing to waste money or unlocking serious value. If you qualify, we'll review your policy 100% for free and give you the honest breakdown you deserve. Click the link in the description or take comment below to apply. Back to the video.
Yeah. And I think if you break down the real issue and the layer underneath it on like why this is happening, well, one, because people can get away with, like you said, but you said that they should be demanding. The problem with them demanding it at this point in time is that everything is ran on a state level, right? And I think that's when you start to look at the banks and they're run on a federal level, and they do things from a kosher perspective and sophistication perspective of a whole lot higher level than any insurance regulations are currently at this point in time. And they are also very understaffed, and they don't have a lot of people that are in the space in general. And so if you have new commissioners, uneducated, understaffed, how in the world do you think that you can get these types of people to understand Bermuda laws, overseas, private offshore things? Like, it's actually not possible. And so they have their own issues to worry about. And so you have to start bringing it to the federal level if you really want this issue to get fixed. Otherwise, this will consistently be a problem ongoing. And I think the stuff that Tom's doing is a very good thing to bring more awareness to the industry as a whole. And also, I want to be clear, like when we say overseas, I don't want to put all overseas reinsurers in the same bucket, because actually majority of the reinsurers and third party that are actually with like really top tier carriers that are doing it well are actually companies, third party carriers in Germany. So, but it's usually the Bermudas, the Caymans, the Barbudas, like those ones that are more private and off the cuff, that they don't have to reveal things, right? At least the Germany ones, like they are required to disclose.
Mothership company, so you're not actually shifting risk. That's the other. That's the other thing, that even if Dom, you were doing dollar for dollar, and it was just a accounting, like, yeah, you get that, it's accounting, I get it. but you're not shifting risk. So reinsurance is a little bit misleading in itself because you're still on the hook for that entire insurance claim.
Oh, you're shifting risk. It's just more risk, more risk. You're not, when you're putting one pocket to the other pocket, and you're essentially saying there's less money on the books from a liability, which then allows you to do other things because you have less debt, quote unquote, to create more debt, and reinvest. Like that's where you're obviously creating slippery slopes and creating issues. And so,
I think
I agree with you though what you're saying.
I think the devil's advocate play, which I tried to share a little bit of this when I was talking to Tom, is why would someone do this? Because I do believe that there's some shenanigans out there that people are just trying to do the wrong thing for people. But I think for the most part, most people that even get themselves in these situations are well-meaning people. So I'm empathetic because I can see, very sophisticated people saying these dang insurance laws are very rigid and I could get a way better return investing in my thing kind of deal. And so they look at this as a way to get around the conservative guidelines of investing. And in their mind, they can justify it because of the rate of return. Well, this is like, there's nothing new under the sun, because this is the equivalent of people with the mentality of you take more risk, you're going to make more money. Well, not always, sometimes, but over time, there are a reason why some of these insurance companies have lasted for a very, very long time. So it's just one of those, like, I can see the other side. I just wish there was transparency, and ultimately the advisor and the consumer's got to know this. And that's the other thing. It's like, okay, if you're going to, as a consumer, take on risk, get better upside. I don't want to take a risk in a life insurance or annuity contract. I'm literally doing a life insurance and annuity to mitigate risk. So the idea of, you're taking on more risk than you think, but limiting the upside is also just like, I don't think most people could actually articulate that.
Yeah. And I actually believe that these executives, et cetera, are doing it at first from an instinct to just like making sure that they could be kosher, that they don't go under, pay a few dividends here and there, right? Because they need to have surplus, like Tom was saying, to stay in business. So it's like, okay, if we're, $1 billion under surplus, it's like, well, if we just move a little bit of this liability over here, then we can now be like positive surplus in the guidelines. And so I think people sometimes play with the line just to be kosher. And then what ends up happening is like greed fits in, and then they realize like, wow, if we did this with, just a little bit, like let's do this with a lot. And I think now you're starting to see that like there's no world where you're not looking at the company that Tom presented on the screen with Athene, is owned by Apollo, that is doing this on purpose. Like there's just way too much money, like that is going into these reinsurance in different places. It's like 96% of it's $200 billion in his reinsurance with Bermuda, and 100% of it goes to its own affiliate. Like that's crazy. Like you said, that's not spreading risk at all. That's playing the system to make the balance sheet essentially better at the end of the day. So it's very apparent that some people are doing it ill, but at the same time, like it's not being accounted for. Like the NAIC, like they say that there's a rule that no more than 50% of even its like surpluses should be affiliated with its investments, and they know that it's happening, but they just keep letting it happen, right? Mm-hmm. For Athene to have like, what was it, like 4.1 billion in surplus, but have $52 billion in affiliate invest, like that is what the 1,200%, I think is what it said it was, is like an insane amount. Like for that to be okay, and for the NAIC just to let that happen, like I think they're okay with it at the end of the day. Like they really don't care, and they're just like, yeah, that sounds good.
Yeah. Well said. The counterpoint is this, and someone actually commented on my video, and I think the comment's really valid. And this person said that there's a fine line between exposing and talking about these things versus, scaring people and getting people riled up or creating extra fear. I'm actually going to pull up my response, but I would love to hear your take on that. And I think it's valid because, anytime you bring something up, there could be then people that freak out for no reason and cancel their mutual whole life insurance or mutual annuity or annuity with a super solid company because they hear one thing and they don't see the whole picture. And then the other aspect is if one company goes down, nobody, including myself, is not going to be celebrating because that's going to make everybody look bad, including mutual companies. Because when one company doesn't perform well, it makes everyone look bad. Hence why the industry itself should not let private equity get in, because it's going to be toxic for the brand of insurance. But curious to hear your thoughts on people saying, hey, don't talk about this stuff, or be careful about talking about this stuff because of the unintended consequences that could come up.
Yeah, I think that this is there's the heads and the tails, and there's the other side of the coin conversation, where it's like you have one side, you have another, but like then there's the reality of it. And the reality of it is there's really good insurance companies out there that are doing really amazing things that have been around for a really long time that should be, I don't want to use the word glorified because that's kind of weird, but should be talked about in the light that they are doing things in the complete opposite nature of these other carriers. And so I think it's important that it is spoken about, talked about, so that way the risk for the overall insurance industry can be minimized. But at the same time, we should talk about these insurance carriers that are doing well, because insurance and annuities are an amazing product. And even Tom said it, he's like, we need insurance and annuities for people to create a contract for a promise for people's financial portfolio into the future, right? And we need them to be around. And I even pulled up some stuff, like if we were comparing like Athene, which is the number one carrier that he was concerned about, and then comparing it to like Penn Mutual, right? So first and foremost, like if you look at when it was founded, right? 2009 is when Athene / the PE firm, PE side of Apollo was. Penn Mutual's been around since 1847, like been around for quite some time. Stock company, right? PE owned, right? And you can see just like brand new relative to a mutual owned carrier. The surplus, right, that is actually shown for Athene is 1.2%, and Penn Mutual is 15%. The offshore reinsurance side, there's all this 96% is with Bermuda. There's zero that's offshore with a company like Penn. The affiliate investments, 1,200%, like we mentioned, and there's essentially basically nothing with a company like Penn.
Yep.
You look at the major captives around it, you have them that has, we talked about Bermuda, Vermont, other things like that. And Penn Mutual only has like one little small Delaware company that's essentially at subsidiary level. And so we can go down the entire list, right, of all the things that these companies are doing versus not. And I think we should point that out because that's important. Yeah. And we don't want to be fear mongers, because there's a lot of really good things that are still happening in the insurance space.
And I think it's really, really important that we start using it more as a selling point. I think sometimes it would be like a sub note, like a cliff note kind of deal, like, hey, like a company's important, but you kind of like, it's like, okay, just like almost like some people would say, oh, the death benefit's important, but like, let's talk about the exciting stuff. Well, it's like, no, this is going to be a really big deal, because if you're going to go down this path, it's essential that the company that you're working with is solid and that you keep checks and balances on that. And if there starts to be a sway, there's mechanisms to get a hold of the company and keep them in check. Maybe we can cue this question, but I just want to give my written response. So I pretty much responded to this comment and said, wonderful comment. I agree that there is a fine line here. I really want advisors and agents to rise up and demand better from the companies we represent. Supply and demand. If we, the advisors and agents, had higher standards, many of the issues would be solved. If the insurance commissioners actually acknowledged Tom's correspondence to them, that would also be a great first step. I think it's crazy that he's reached out to a bunch of insurance commissioners and he doesn't even get a response back. I think that's wild.
They have their own problems though. They're like swamp. I mean, it's like a business owner. If you have like 100 responsibilities.
I hope people send our videos to them to say, I get you have your own issues. Tom will work for free. He's done a bunch of work. Have him help you.
That's a good point.
draft the letters. And I don't know if he'll work for free. I probably misspoke there, but like he'll work.
Yeah.
I know. Like, I asked him, would you speak to any? And I even have
he
some
did
other
say
people that I'm working on, and he said, I'll sit on any meeting. Like, he cares about this. But then I go on to say, I don't want people to panic, but I do hope that this creates accountability or greater accountability. We'll be interested to see how this plays out. Really appreciate your thoughtful comment. So I thought the comment was well received, and I just, it made me think of like, okay, there is a fine line here, and why am I okay with publishing this and continuing to platform Tom, which, by the way, Tom will be at our life insurance summit, and I know some of the things that he's going to say, and it's going to be another breaking news kind of deal. So it's going to be fun to experience that live in person.
Amazing. Is he speaking?
Yeah, he's going to be a speaker.
Amazing.
He's going to be
Rightfully
breaking
so.
He's going to be breaking some stuff that is, again, going to be very timely for our space.
Amazing. Well, if you guys want to come, buy a ticket.
Get your ticket. Get your ticket. If you're watching this before June 15th, we have our event June 15th through the 17th. And if you're watching this after, get your tickets for next year's event. No promises, but it's going to be amazing. And I will work like crazy to make sure that it will be amazing.
If you're an advisor, life insurance agent, or someone who just loves the life insurance space, we have a must-attend event for you. It's our 5th annual Life Insurance Summit, June 15th through the 17th, right here in Nashville, Tennessee. Not only are we gonna have the biggest names in the life insurance space, but this is also an incredible opportunity for you to meet and connect with like-minded individuals and be a part of our ever-growing community. Learn more and get your tickets before they sell out in the link in the description or pinned comment. Can't wait to see you there.